Your cloud is literally on fire right now. Not metaphorically. Iranian drones just punched holes through 3 Amazon data centers in the Middle East. And if you own anything in the Nasdaq, or frankly any index fund, this affects you directly, whether you realize it or not. Look, if you're short on time and you don't want to listen to some guy with a cat avatar break this down for 10 minutes, here's your one takeaway. This is not an Amazon story. This is an energy and escalation story. The Strait of Hormuz is shut. 20% of global crude is stuck. That's the variable that decides whether your portfolio bounces or bleeds for weeks. Everything else is noise around that signal. Alright, if you're still here, I'm going to walk you through exactly what happened, why Wall Street is repricing everything right now, the specific price levels I'm watching on QQQ, and the 3 realistic paths forward so you can actually make a decision instead of just doom scrolling on social media. Quick thing, if this kind of real-time breakdown is useful to you, consider hitting like and subscribe. No course, no Discord upsell, no link in bio nonsense. I just make these because honestly, I spent years as an analyst inside a Fortune 50 company staring at dashboards nobody read, and now I'd rather talk to a camera and my cat. Speaking of which, my cat just punched my second monitor during the futures session this morning. So you know, he's also processing this news in his own way. My name is DataCat. This channel's only about 7 months old. I'm still figuring out topics, I'm still figuring out thumbnails. I'm an introvert who accidentally started a YouTube channel, so if I sound a little too calm for a day when the Kospi dropped 7%, let's just say that's my way to cope with my fears. Alright, let's get into it. So here's the situation as of this morning. Iran has been targeting nearby areas since the war started. It retaliated with drone strikes across the Gulf, which doesn't make sense at first glance, but now we know the reason why. Because apparently, 3 AWS data centers got caught in the crossfire. 2 in the United Arab Emirates took direct hits from Iranian drone clusters. A third in Bahrain caught partial damage from strikes on nearby infrastructure. Now, Amazon put out a statement confirming that AWS Lambda, Amazon Kinesis, CloudWatch, Amazon RDS, and other services, quote, remain degraded. And then they said something that should make every cloud architect's stomach drop. They used the word prolonged to describe the recovery timeline. And then, and this is the part that really tells you how serious this is, AWS explicitly recommended that customers migrate workloads out of the Middle East entirely. Move them to the United States, Europe, or Asia Pacific. When the provider itself tells you to leave the region, that's not a PR statement, that's a fire alarm. And naturally, Amazon opened about 2% lower on Tuesday. It had already closed down about 0.8% on Monday. But that's not it, because there's a much bigger implication behind all these. You might be thinking I'm talking about Amazon stock specifically today, and this is where most people are going to get it wrong, so I want to make sure you don't. First, there are 2 layers to this, and the market is pricing both of them simultaneously. Layer 1 is the cloud and data center angle. Reuters reported that Microsoft, Google, and Oracle also operate facilities in the UAE. None of them immediately responded to press inquiries. So the market isn't just repricing Amazon's operational risk, it's repricing the entire concept of regional concentration for physical compute infrastructure. Where does your AI model actually live? Where does your data actually sit? If a drone can knock out a data center, what's the risk premium on every hyperscaler with Gulf exposure? That's Amazon, Microsoft, Google, Oracle, and even AMD and Nvidia, and honestly the whole AI and data center complex. All the previous catalysts about Gulf investment and cooperation now suddenly become a nightmare. The market is now asking a question it wasn't asking last week. What's the geopolitical risk of where compute physically lives? But layer 2 is the real driver, and this is what I think most retail investors are underweighting right now. The Strait of Hormuz is effectively closed. Iran shut it down, and it remains shut as of right now. About 20% of global crude oil transits through that strait. That's not a rounding error. That's a fifth of the world's oil supply. Major oil companies and traders have suspended shipments. Insurance costs for transit have gone through the roof, which functionally means even if someone wanted to send a tanker through, the economics don't work. CBS News, CNBC, Reuters, they're all covering this as a global trade disruption, not a regional skirmish. So what does that mean in practice? Oil spiked another 7% on Tuesday. European natural gas futures shot up 30% because Europe sources a huge chunk of its LNG from Qatar, and guess what? That gas has to move through or near the same choke point. The Korean index Kospi sank over 7%, Euro Stoxx 50 dropped 3.75%. Even gold, the supposed safe haven, declined 5%, and I'll explain why in a second. The S&P, the Dow, the Nasdaq all opened rotating over 2% lower. This is not sector rotation. This is not sell tech buy defense. This is correlated selling. Everything is going down together, and that tells you something very specific about what regime the market is in. This trips people up every time, so let me explain it quickly because it matters for understanding what's happening under the surface. When you get a genuine shock event, correlations go to 1. That means everything sells together. Gold, equities, bonds, crypto, all of it. Why? Because when margin calls hit, when funds need to raise cash, when liquidity thins out, people sell what they can, not what they want to. Gold isn't falling because the market thinks it's less valuable. Gold is falling because someone, somewhere needs cash right now and gold is liquid. That's a deleveraging signature. Alright, so let's talk specifics. But for the time being, the market hasn't closed yet. This is a live situation. These are the levels I'm watching right now as I'm recording this. First, the line in the sand, around $591 to $92. That's the 50-day low. If QQQ closes a full daily candle below that level, especially on expanding sell volume, the odds shift hard toward this isn't a base, it's a trapdoor. That's the level where the character of this sell-off changes from shock and recovery to trend breakdown. Second, the must-hold zone for today around $593 to $94.70. This is where price gravity sits right now. If we lose this range intraday, the market is essentially volunteering to go test $591.87. No one's forcing it, it's choosing to go there. Third, the first prove it reclaim zone, $598 up to about $604. These are former 1-hour supports that are now overhead resistance. If QQQ can't reclaim this band, any bounce you see is likely a dead cat bounce. And yes, I'm aware of the irony of me, DataCat, using the phrase dead cat bounce. My cat is glaring at me right now. He finds it offensive, I find it technically accurate. Fourth, the bigger trend repair level, $607, that's the important daily pivot. If QQQ can reclaim 607 and hold it as support, that's your first real signal that the daily structure is repairing. Until then, you're trading inside a damaged tape. I'm not going to pretend I know which one plays out. Anyone who tells you they know is selling you something. But I can frame the scenarios so you know what to watch for. Path A, retest the low, hold relief rally. QQQ dips toward 593, maybe tags 591.87. Doesn't break, then reclaims 598 and pushes into the 602 to 604 zone. If that happens, 607 becomes your next checkpoint. If 607 flips to support, that's the first daily structure repair signal. What would need to be true for this path? Energy stops squeezing, or at least stops getting worse. Headlines shift from escalation to containment, restoration, rerouting. You'd probably see QQ stop underperforming SPY on a relative basis. Path B, and honestly, this is the most common outcome in headline-driven wars. Volatile chop under resistance. Lots of intraday rips that feel like relief. But QQQ keeps failing in the 598 to 604 zone, or it gets rejected at 607. Eventually, it either forms a cleaner base, which takes time, or it breaks 591.87. This is the market is reassessing the risk profile tape. Multiples compress, rallies get sold, dispersion stays high. It's exhausting to trade and exhausting to watch. Path C, break 591.87, acceleration lower. A clean breakdown through the 50-day low, especially on heavy volume or after a fresh escalation headline. Then you're outside the known range, you're in price discovery to the downside. The key tell for whether Path C is happening is not RSI, it's not MACD. It's whether breakdowns start attracting more volume and worse closes instead of snapping back. That's the behavioral fingerprint of genuine distribution. I want to be really clear about this because it's easy to get lost in the noise. The single biggest swing factor for QQQ right now is not AWS in Bahrain. It's not Amazon's stock price. It's this question. Does the market believe the energy disruption persists for weeks? If yes, that bleeds into inflation expectations, which bleeds into central bank expectations, which bleeds into discount rates, which compresses every long-duration equity valuation in the Nasdaq. That's the transmission mechanism. Drone hits a data center, that's bad for Amazon. Strait of Hormuz stays closed for weeks, that's bad for everything. And as my last video has pointed out, Trump said this war could last 4 to 5 weeks. Geopolitical experts are saying this wave could last longer than the first round back in June 2025, which lasted about 12 days. The security situation is deteriorating. Iran largely destroyed the US embassy in Saudi Arabia late Monday. The US is evacuating embassy staff across multiple Gulf countries. This is not de-escalating yet. Instead of guessing, here's what I'm monitoring, and you should be too. 1. AWS status and restoration pace, because that's your all-clear signal for the cloud-specific angle. If Amazon starts bringing services back online, that removes one layer of uncertainty. 2. Shipping and insurance behavior through the Strait of Hormuz. This is the macro throttle. If insurers start offering coverage again, If tankers stop moving, that's your signal that the energy shock has a ceiling. If they don't, buckle up. 3. Relative strength of QQQ versus SPY. If QQQ underperforms persistently, day after day, that's telling you this is a risk-off plus duration unwind, not just a one-day panic. 1 day of underperformance is noise. 3 or 4 days is a message. 4. Breadth inside the Nasdaq. Even informally, just look at whether only a handful of mega caps bounce while everything else stays heavy. If that's the pattern, rebounds tend to fail. You want to see broad participation on any recovery attempt. And in somewhat surreal timing, AWS also announced today that it purchased a satellite campus from George Washington University for $427 million in Virginia, 120 acres for a new data center. On the same day, their Middle Eastern infrastructure is literally smoldering. If that isn't a real-time lesson in geographic diversification, I don't know what is. Even my cat keeps his toys in multiple rooms. Basic risk management. Look, this is a fluid situation. I recorded this while the market is still open because I think the framework matters more than waiting for a closing print. The levels are the levels, the scenarios are the scenarios. The variable that matters most is Hormuz, not Amazon's earnings guidance, not whether Bahrain gets a replacement server rack. Stay level-headed, size your risk appropriately. And if you found this useful, like and subscribe. I'm just a guy, 7 months into a YouTube channel trying to make sense of the tape in real time. No courses, no paid group, just analysis and the occasional cat interruption. This is DataCat. Stay sharp. I'll see you on